Hello, it's Friday the 30th of April. My name is Neil Shearing. I'm the Group Chief Economist at Capital Economics. This is your week at Capital Economics, and it's been one in which two of the central themes of our global economic forecasts for this year have started to come into sharper focus. The first of those themes has been that we have been anticipating a strong economic rebound in most countries this year, and we got evidence of that in the first quarter GDP data released in the US on Thursday. And we anticipate further acceleration in growth in Q2. You can read all about that on our US service from our chief US economist, Paul Ashworth. I think it's fair to say the data from the Eurozone have been far more mixed. Certainly the Q1 GDP data released on Friday were certainly softer than had been anticipated in Germany, but surprised on the upside in France. And most importantly, the survey data that were released this week from the Eurozone provided a strong hint of a better start to Q2. So you take both of those things together, and I think we can say that the economic recovery, the global economic recovery, is on track, and we remain confident in our view that economic growth this year at a global level is going to surprise on the upside. The second central theme of our research for this year has been continuing policy accommodation by central banks. And that was really the main message that came from the Fed meeting on Wednesday. Policymakers in the US essentially saying the economy is improving, the economic outlook is improving, but we're going to stay the course. Policy accommodation is going to remain in place. And you can read all about that and the implications for financial markets from our senior markets economist, Oliver Jones. One of those implications being a steeper US yield curve. Now, the combination of strong economic growth alongside continuing central bank policy accommodation raises the spectre of inflation, and it's simply an issue that is not going to go away. Many people have been drawing comparisons with the 1970s, but in a major piece of research published this week on our Global Economic Service by our senior global economist Simon McAdam, we argue that parallels with the 1970s are somewhat overdone, and in particular, institutions and structures in the global economy are very, very different now to what they were back then. Now, that doesn't mean that we won't see an uptick in inflation as economies open up. Demand is released and there are continuing supply side restrictions in place. And our head of global economics, Jennifer McEwen, is going to be hosting a webinar next week on Thursday, explaining how we intend to track evolving price pressures as economies open up, and in particular, taking our clients through dashboards that we've set up to help them navigate these developing price pressures, all of which is on our data and analytics platform, CE Interactive. If you're interested in any of that, and in particular the webinar, sign up on our website. There's a link below. Other things we've been writing about this week, our senior India economist Shannon Shah has been picking through the economic and market implications of the surge in virus cases in the country, in particular the implications for the banking sector. Our UK team have been picking through the MPC's forward guidance and explaining what that might mean. And our Eurozone team have explored whether or not the ECB might start to think more about house prices when setting monetary policy, and how that might be embedded in different measures of inflation and indeed policy targets. If you're interested in any of that, you can find links in the email below and on the page below. You can find all of that on our website. Thanks very much for listening. Have a great weekend, and I'll speak to you next week. Goodbye.